Hi, this is Editor's Take. I'm Sakshi Batra, and with me is Gaurav Chaudhary. He's the Deputy Executive Editor of Money Control, and we are here to discuss about the decisions taken by the RBI in its latest monetary policy review made today. Thanks a lot, Gaurav, for joining in. So, a third consecutive cut in the repo rate in a row by the RBI. 25 bips has been cut. Even the stance has been changed to accommodative from neutral. Your first thoughts there?
Well, this was unexpected lines, and this is something that everybody had been talking about. Given the fact that only last week on 31st of May, the government came out with the GDP data, and it had fallen to 5.8% in
Yes.
Jan-March. Inflation remains very comfortably within RBI's tolerable limits of plus minus 2 or 4%. So it was only expected that the RBI is going to take a position on the MPC, rather is going to take a position on reducing rates. And this time, clearly there is a change in focus from controlling inflation to boosting consumption and investment, and that is the reason probably the MPC has gone ahead and changed the stance to accommodative. In fact, in one of the lines in the policy, the MPC has clearly stated that there is enough scope for further rate cuts, and not in as many words they've said, but they have signaled that the MPC is probably favorable to more rate cuts if lower inflation levels persist. Clearly, the focus has shifted now to boosting growth, boosting investment, and spurring consumption rather than controlling inflation, which remains very, very comfortable.
Absolutely. And RBI Governor Shaktikanta Das has also said that rate hikes are completely off the table right now as we speak. But I want to ask you about this particular sectors, the rate sensitive sectors such as auto and real estate. How good a news is this? Because we've already seen 75 basis points cut in the 3 policy meets that we have seen so far. Will it be enough to boost the demand? Because these are the sectors that have been facing some bit of slowdown, as is evident from the car sales also.
Clearly, a lower rate cut, a lower interest rates is going to have a more immediate impact on car sales than on real estate. And real estate, as we know, is a function of it's a long-term kind of a consumption spending. Whereas in the case of automobiles, in the case of cars, people do tend to get influenced by lower interest rates to buy. I mean, that's a determinant in buying a car, not as much a determinant in buying a house. All the lower rates are important also for buying a house, but more important is in expectations about income and rise in income in the coming months and years. Because that's a more longer term repayment schedule, not as much with cars. So I would expect car demand probably to pick up, but car demand, as like any other demand, it's a consumer durable, and a consumer durable demand is determined by 2 things. One, interest rates, which in this case the RBI has and the MPC has obliged, but it's also determined by current income levels and what people believe their future income levels are likely to be. So it's more about expectations about their future income than about anything else. So if people believe their future income are going to remain flat or only going to rise marginally, that might not have the desired impact on car sales as it would have otherwise been.
Absolutely. Do you also believe that the change of stance to accommodative now will make it easier for banks to transmit these rate cuts faster to consumers?
So the RBI governor in the post-policy interaction with journalists did make it very clear that the central bank was monitoring what is called monetary transmission. That is the extent to which banks are passing on the repo rate cut.
Okay.
And in between February and April, the repo rate was cut by 50 basis points, but the weighted average of the interest rates, the extent to which it has a monetary transmission has happened, is only 21 basis points. And in fact, in existing loans, actually interest rates have gone up according to the policy. So clearly, older loans banks continue to charge at higher rates than newer loans that would have been probably granted and sanctioned after February.
Sure.
Clearly, there seems to be more scope for banks to reduce rates, and the RBI is saying that it's going to monitor monetary transmission. The extent to which consumers benefit from a lower repo rate will also be very largely determined by the extent of monetary transmission.
Absolutely. Now I want to bring your focus to 2 very important points. One is growth, and the other is inflation. The RBI has revised in its latest policy the H1 FY20 CPI inflation estimate upward to 3.1% from 2.9 to 3%, and it has cut the H1 FY20 GDP growth forecast to 6.4 to 6.7% from the earlier forecast of 6.8 to 7.1%. Even the FY20 GDP forecast has been brought down to 7%. 7%.
Yes.
How big a concern is this?
No, it is a concern, and it only reiterates what the other proxy indicators have been, showing. Car sales are down, so it means the consumption is down. And this did show up in the GDP data, which the government released on May 31. The Jan-March had fallen to 5.8%.
Yeah.
But if the RBI is saying that GDP, real GDP or inflation-adjusted GDP growth is going to go up to about 6.4% in between April to September,
Yeah.
it means there is a pickup, because from 5.8 to 6.4 average in 2 quarters, it means there's a significant pickup. And
Yeah.
beyond that, if the full year growth has to come in at about 7%, that means from October to March, growth has to really accelerate.
Yes.
So the RBI believes that growth is going to pick up probably from June onwards or July onwards, and that is what their own surveys, expectation surveys, are also saying, and that is what the policy statement has also indicated. Clearly, their investment activity at this point in time remains extremely sluggish. So does consumption, and it's also, the economy has been is currently buffeted by an uncertain external environment, primarily because of US-China trade tensions. But having said that, the turnaround in the economy will critically depend to the extent consumption picks up.
Absolutely. And lastly, Gaurav, I have to ask you about that the markets have not really taken the RBI policy very favorably, despite it being so accommodative, change of the stance as well as the rate cut that it was already probably anticipating. But what has really disappointed the markets, if you could point out?
So there are a few regulatory policies changes also, which is not part of the policy, which are decided by have been decided by the central bank but released today. MPC, the Monetary Policy Committee, as we know, its remit is limited only to interest rate decisions and based on certain inflation targeting benchmarks. There are other decisions that has been taken in the regulatory space, but markets probably were expecting a 50 basis point cut.
Okay.
And that did not come about. 25 basis point cut is 25 basis point cut in the repo rate. Probably the market thought was something on the lower side, and there was enough scope and enough scope for the RBI and enough elbow room for the MPC to actually recommend the 50 basis point cut. That was not to come about. But that said, the RBI did clearly mention a change in the stance from neutral to accommodative. And RBI is saying that there is scope for the MPC to, oblige it probably another rate cut in the coming months. Since a rate hike is off the table, I think the market should have probably taken it more favorably.
Right. Thanks a lot, then, Gaurav, for sharing all that insight with us. Well, the repo rate is now down to 5.75%. It is below 6% for the first time since 2010. So definitely good news for consumers over there. Concerns remain on the inflation, the upward estimates on the inflation front and the lower estimates on the growth front for sure, which we'll have to wait and watch out for. But what we'll also have to watch out for is how soon will the banks be really transmitting all these rate cuts to the consumers so that all the demand can be boosted for at least sectors like auto. Thanks a lot for joining us in this edition of Editor's Take, and do stay logged on to moneycontrol.com for more news and updates. Thanks for watching.